Welcome back to another episode of Friday Financial. And today we have Danielle, who is in our consumer lending department, to share some knowledge with us. So thanks for hopping on, Danielle.
Hello, thank you for having me.
So today we're going to talk about qualifying for loans. And a lot of times, rightfully so, people associate their credit score with qualifying for loans or mortgages or whatever the case may be. But there's another big piece there. And that's your debt to income ratio, also known as DTI. So let's talk about that a little bit and share with us what exactly is debt to income ratio.
Yes, I would be happy to explain that. So debt to income ratio is basically it's the percentage that represents how much debt a borrower has in relation to how much income they bring in.
Mm-hmm.
So that's basically the simple explanation.
Okay. All right. And why does it, when a lender is looking at your application, why is that important to them?
So this is important, and I believe this is something that you should care about because it's one of the main deciding factors of creditworthiness. Mm-hmm. This number is used by most creditors, most lenders, in addition to other factors like credit score, credit history, time on job, stuff like that. We use all these to determine if a borrower has the capacity to pay new debt. So do they have enough income in relation to their debts to pay back on a new loan?
And that's really important, right? Because sometimes we'll hear people say, oh, my credit score is 720 or whatever the case may be, and I got denied and I don't understand why. But this could be one of the reasons why.
Yes, and typically in those cases, when you do have somebody with a very high credit score, if they do get a denial, it typically is because of the debt to income ratio.
Because it may literally be telling the lender, this person is not making enough money to take on this additional debt.
Exactly. Yes, that's correct.
So what is, how do people... people, I think at this point have the general understanding that I should check my credit score and know what's happening before I apply for a loan. But how do people understand where they sit with their debt to income ratio?
So this is actually something that you can do yourself. You can estimate what your debt to income is. Quick disclosure though, some creditors will use gross income, which is the amount you make before taxes. Sometimes that includes also other deductions that come out from your gross income. So gross income is what you make before all of your deductions and taxes come out. Some lenders will use your net income. So that's after. So that's your take home pay. So what you actually get is your net income. At MHV, we use the gross income. So we will use what you make before taxes and deductions in order to use that towards debt to income. So this is something that you can estimate yourself. It does take a little bit of work and you need a calculator. And basically what you're going to do is if you have a pay stub, you're going to look at your year-to-date on your pay stub, and you can actually divide that by how many months in you are from the pay period. So for example, if your pay stub is dated for June 1st, that shows 5 months of pay. So you can take what your total year-to-date income is, divide that by 5, and that's kind of where you get your gross monthly income on average. We usually use the average for it. So what you're going to do is you're going to take that number, and then you're going to add up all of your debts that you have. And these are all reported debts. So we can only see what's on your credit report. If you have other monthly obligations that are not reported on your credit, you may want to factor those in just for your own peace of mind. However, we go by just credited, reported debts. So you're going to add up all of your monthly payments. So your mortgage or your rent, your car payments, your credit card payments, any other debts that you have, and you're going to take that total number and divide it by your monthly gross income. That number is your DTI percentage or debt to income ratio.
Okay, so someone does that, and I don't know if you can answer this or not because my guess is it's probably a wide range.
Yes.
But is there a percentage that someone should feel good about before applying for a loan?
So it actually does vary. It's hard to give an exact number to that, only because each lender has their own guidelines. And sometimes their guidelines vary based on credit score. So the way that we do things at MHV is we will change that percentage based on what your credit tier is, which is basically a range of credit scores. So if you're, just for an example, if you're in our top tier, we'll usually give you up to 55% on that. Usually it's, everything is a case by case basis. So really it's hard to give an exact number to say, okay, this is a good number. And that's not to say if your number's lower, if your credit score is lower, that number should be lower. So it really is a good idea to keep it as low as you possibly can. We do see typically people range between like the 30 to 60% range. So if you're looking for a good range, I would stay on the lesser of that, so more towards the 30, but there is no exact number that we can give you.
Okay, that makes
sense. Just
try
to keep it as low as you can.
That makes sense. So if you have like a 70%, you should probably take some action before applying for a loan. But that brings up an interesting point, because let's talk about people who are looking to consolidate debt. Most likely their debt to income is probably already pretty high if they're trying to consolidate debt and save some money. So how does that play out? And again, this might be like case by case basis, but I don't know if you could answer that generally.
So if your debt consolidations are a good way to lower that number. It does depend. Again, everything is a case by case basis. But if you're looking at somebody that has a lot of credit card debt consolidation is usually a good thing, because credit card debt tends to fluctuate depending on how often you use your credit cards. If you use your credit cards often, your minimum monthly payments are going to be higher. So that's going to increase your debt to income ratio. If you're not really using your credit cards too often, it's probably best to just hold off on doing a debt consolidation, because having that available credit is also very helpful with your credit cards. But if you're looking at just your debt to income ratio, lowering your payments is the best way to lower that debt to income. So if you find that you have a lot of credit card payments, maybe a few unsecured loans that have high interest rates that give you high monthly payments, looking into a debt consolidation is definitely, it's something that's recommended for that.
Now, how does that play out? Because someone watching this may think, but my debt to income is already high because I have all these debts. How would I get approved by wouldn't adding another debt in the form of this loan make my DTI even higher? So walk us through that if you can.
That's actually a great question. We actually offer debt consolidation loans that are specifically for debt consolidation. And what we will do is we will take those debts that you want to include and we'll exclude them from your debt to income ratio. Because what's going to happen is once we approve that loan and fund that loan, those debts are going to be paid off. That's no longer part of your debt part of the ratio. So we do factor that in. We will take that into consideration when we're reviewing and trying to decision a loan. So it is important, if you do apply for a debt consolidation, to make sure that you're communicating that it is specifically for a debt consolidation, and then maybe have a list of the debts that you want to include so that we know, okay, we can exclude these from your debt to income.
That makes perfect sense.
Yeah.
Danielle, do you have any other thoughts you want to share with us about debt to income ratio?
Well, I do want to touch really quick upon improving it. So debt consolidation is definitely one. Another way to kind of decrease your debt to income ratio is making sure that if you're using your credit cards often, that you're making a little bit more than your minimum monthly payment each month. That kind of helps bring down your balances in total. Will also increase your debt, will decrease your debt to income ratio while also increasing your credit score. You can also look into ways to increase your income. That's another way you can do it. So if you have, as you can get a second job, some side hustles, you can make some extra money off of it. But if you feel that you're so buried in debt that debt consolidation just isn't going to work for you, this is kind of a last resort. You can always talk to a debt relief program, which I don't recommend that as a first option. You should definitely wait until you exhaust all of your other options. Also, bankruptcy is an option as well, but that's not something that we recommend either. Definitely try to look for ways to increase your income and decrease your debt first before you go to those avenues. So.
Yeah, we've had conversations with Hillary, whom you know, and she echoes what you say and kind of avoid the debt relief program.
Try to avoid it at all costs.
All right. So just to summarize, you want your debt to income ratio to be lower because that means less of your income is going towards debts, which means you can handle more debt.
Exactly.
Okay. Yep. Awesome.
That's
awesome.
Perfect.
Thank you so much for having me on today. We appreciate it. And I'm sure that this information is going to help people who are in the process of applying for loans.
Good. Thank you so much for having me.
Yeah, take care. Have a good one.
You too.
Bye-bye.